three cool strategies: direct indexing, and for the highly appreciated stocks or a large position, protecting it with a collar, and creating more income with a covered call strategy. But once again, it's not for the amateur. You want skilled professionals working with you on that strategy.
Today's episode is brought to you by Security Financial Management.
Welcome back to Best Advice Podcast, guys. I'm your host, Rob Lavalio, here as always with Mitch Allen and Dave Allen, senior and founders of Security Financial Management, senior advisor as well, certified financial planner. Gentlemen, that's a lot to say, but what's cracking this morning?
Hey, you're cracking, Rob. Cracking me up.
Let's get right into it today with the question of the day. Today's question comes from Casey from Lake Nona. Casey, what you got for us?
I have a great stock I have owned for 30 years, and it has an extremely low cost basis. If I sell it, there's a huge tax liability. I still love the stock, but do you have any strategies you recommend for this situation?
Thank you, Casey. Gentlemen, insight me, please.
All right, Mitch. And this is a question that we have not as much as you would think, because a lot of people do not hold a stock for 30 or 40 years. But believe it or not, there are some out there. And if you are that patient and owned a very good position, it could be worth a lot of money. So, Mitch, why don't you talk about a couple of, maybe one of the strategies, and then I'll add on to that.
So one thing that you obviously want to do with a position that you've owned for 30 years, obviously it's done really well over the past 30 years. So you have a very low basis probably, and you have a very high value. So what can you do? You have to protect that position. So one thing that we've been doing with some of our clients is actually an option strategy called a collar. A collar is a
like
way...
a shirt collar?
Not quite, but you know.
It's spelled the same?
Yeah, we'll think of a collar kind of as a way to put a protective fence around your stock. It's an option strategy that's really designed to limit your downside. It will cap your upside a little bit, but what it does is it protects your downside. So, you know, what you do is you
But
buy...
you could put different formulas to it, right?
Yeah, you could say, you know, I want 15% protected on the downside, and in exchange for that, they price the options to say, all right, with 15% downside protection, you'll get a 10% cap. So someone might say, you know, I'm okay if my stock position goes 10%, but I really don't want it to go down 16%. So this would be a strategy that you could put in place. You'd buy a put option, which gives you the right to sell your shares at a specific floor price, as it's called. And this is kind of like your insurance policy. This is your floor. So, and simultaneously you sell a call option. So by doing that, that gives someone else the right to buy your shares at a specific ceiling price. So what you're doing there is you're kind of capping your upside, but you do receive a premium for that call. So they actually pay for each other, the call and the put. So it's a very low cost strategy that you can protect your position in a really efficient way, utilizing options.
See, what happens is as the stock value goes down, the lower position actually, the option rises in value. So it helps you, you know, let's say you add $1 million of it and it drops to 900,000. Well, the underlying position, option position rises in value. So now your overall money is basically still the same. You protected it. And then, you know, and on the upside, you've given up some upside for the protection on the downside. I'll tell you where that has happened to, you know, a lot of people, if they have been acquired, their company's been acquired, and they get acquired in a publicly traded stock, and maybe there is a hold period, a certain hold period that they have to keep it, and they want to make sure that for that maybe a 3 or 4 year hold period, that they're not going to lose their stock due to some bad stock market before they can sell it. And so that you can collar that stock position to protect its value, because you're more concerned about in 4 years, do I still have my money here? Because we've seen some circumstance where people have been bought and they chose the heavy stock options. I would rather be bought in company stock, they would say, as opposed to taking cash. And sometimes they'll give them more value in stock than they give them in cash. And so Now they've got 4 years to wait. And if you have a bad market in middle at the end of that 4-year period of time, you've actually gotten less than you would have gotten in cash. So you can actually get that position. If it's a publicly traded stock that allows you to do a collar on it, you can protect that position knowing that at the end of that period of time, I still have my money.
Is it basically for someone who, say you're 70 and you're ready to retire and you're happy with how your performance is done in that specific stock and you're like, I would love to get out, but the taxes are going to be crazy on it right now?
Right.
Is that what you would put this in?
Yeah, so people that maybe they're living off the dividend of it, but they want to make sure that if they die, they want their family to inherit it in its current form. You can protect its value by doing that.
Yeah, that's a really nice way to manage risk in a concentrated position is really what it
And
comes
you don't
down
have to do it on all of it. If you have a very large position, just say, I want to create protection for this amount. Another strategy that we see with a highly appreciated stock or a very large stock position is that I don't want to sell it, but I want extra income. So there's some stocks out there that have a very nice dividend that's paying. And so in addition to the dividend, you can put another strategy called
the covered call strategy.
Covered call strategy.
That would be if you're not worried about protecting the position, though. That would just be, let's say I wanted to hold the position, you'd write out of the money options, just basically trying to receive the premium income to basically jump in on top of your dividends. So you're still be entitled to the dividends that you receive from the stock, and you'd still own the stock, but you get that extra premium income.
It's a way to create extra income
Exactly.
on a position. So, if you got, $1 million and something like that, you might find yourself creating an extra $25,000 or $30,000 a year on top of your dividends. So we always warn with caution, you want to make sure that if this program is being done for you, it's done by very experienced, knowledgeable
that gets
people in
You
that
get into the
category.
weeds with options,
Yeah.
We have some companies that we work with that absolutely specialize in this deal. So they're our teammates, and that's what they do. They live by it. It's not something I would really recommend unless you were very skilled at that to do it on your own.
Yeah, I remember in '65, that was the hardest part with us. That was simple ops.
Oh, the options.
Just the simple stuff. Like,
Because
this is a whole
everything's
different
backwards.
level. Yeah.
Everything's backwards. Should you sell a put or buy a put?
Yeah.
Should you sell? No, it's
I had
it's
some difficulty with that one for sure.
Yeah. We'll end it with one little quick topic here. That's unrelated to options.
Yeah, it's not an option strategy, but what it is, it's a way.
What's it called?
It's called direct indexing, and in general, what it means is that you're going to target an index, call it, let's say, the S&P 500, and you're going to buy probably 300 to 500 of the stocks that are available in the index. You're actually going to own the stocks. You're not just going to go out and buy the exchange traded fund SPY. You're going to actually own every single stock position. And so what that allows you to do is that on a daily basis, you can go in and harvest losses that you can use to actually eat at, the large gain you have in your appreciated stock. So, you could just go out and buy an ETF of SPY, or you could buy direct indexing. They'd have the same exact performance.
Similar, very, very,
Very, very similar. Almost a one tracking area. They'd almost be lockstep with the performance. But on the direct indexing strategy, you'd actually get yourself some gains or some losses that you could generate and add them to your bank and use them against the gains that you had for the appreciated stock.
So as Mitch was saying, you could own the S&P 500 in an ETF or a mutual fund, or you could own the S&P index in a direct index. The difference is one position, 300 to 500 positions over here. On a daily basis, even on an intraday basis, they're looking for, let's say, Johnson & Johnson's down a fraction in that day. They will sell the Johnson & Johnson position, replace that with so its money stays invested with almost a similar performing stock
that has a tracking error close to 1.
Yeah.
Basically, if the S&P moves, it moves right with it. So
cool, yeah.
So you're banking some losses, and I tell you what, that adds to your overall return. And let's say you've sold a piece of property, real estate, on your own, and you've made money on it. And at the end of the year, let's say you made $100,000 or $200,000 on selling a rental property. Well, that's long-term capital gains. So you can take the losses that are generated from this to offset, so you pay less taxes on that gain. So it's an extra benefit, which adds to your overall real rate of return. So that's a strategy that you typically have to have, with our program that we utilize, it's $250,000 or more to be in a program like that.
You need enough clay to be able to buy 500 stocks. That's a high minimum. So
Right.
it makes sense.
I like
Right.
the word clay.
We like to shape that clay,
Yeah.
into yes, but $250,000 or more, and it will create an ongoing and the amount of losses it generates a year will vary from year to year. I think last year they were telling us that it might have been a 5% of your overall amount. The previous year was quite a bit more, so it will vary from year to year. But if you don't use a loss in 1 year, maybe you had no capital gains in that year, that it will move to the next year and you'll bank up those losses. So it's a great way to get all the performances of the index and creating that extra benefit that when somebody is high net worth client, they're creating capital gains in other areas. It helps with your taxes. It's not the only
It's not
solution,
going to eliminate it, but it'll help.
but it's a way. So anyway, that's
It's amazing.
that's
Yeah.
pretty
That's
much
awesome.
those are two pretty, actually three cool strategies: direct indexing, and for the highly appreciated stocks or a large position, protecting it with a collar, and creating more income with a covered call strategy. But once again, it's not for the amateur. You want skilled professionals working with you on that strategy. So if anybody is interested in discussing either one of these strategies in more detail, reach out to us at SFM, Security Financial Management, and we'd be happy to coordinate a call or a meeting or whatever makes sense for you.
Absolutely. We'll leave a link in the description right here. Hope that helps, Casey. Remember, folks, the secret to wealth is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.